Good evening. This is Doc Severson for the TheoTrade report for Tuesday, May 30th. I'm starting out tonight looking at the S&P 500 ETF, or the spiders. And tonight's volume, or today, we showed about 35 million shares traded on the spiders. Now, as I look back over the course of the last couple of years, that is actually the lowest value of volume traded on the spiders, and this is including Christmas week, Thanksgiving week for the last couple of years, which are traditionally very, very low. Today was the lowest volume day over the last 2 years. Now, it's not hard to see why. We just lack a catalyst right now for markets to move at all. So we've gotten past our little V bottom after the mini panic from a couple of weeks ago, and markets can't continue to just manufacture these crises and then short cover their way higher from here. That's pretty much what happened back in 2015, but this is not going to continue on and on and on, right? So what's the catalyst here? Well, the next real catalyst, we have the beige book tomorrow. Sometimes that can act as a little bit of a kicker for markets, but really we're kind of stretching it there. And so then we get into the ADP report Thursday morning, which is really kind of a prelude up to Friday morning's non-farms payroll. So last cycle, we actually did have a very good report. So you can see prior was 211, which is well above consensus. And right now, again, the consensus is 185. So 185,000. And continuing to see whether the participation rate will increase and the unemployment rate will continue to drop. We'll see whether or not that will be the case. Also, what they typically will do is update past numbers. So sometimes that can lead to a little bit of a bump. But you can see kind of the trend has been going in the wrong direction here for the better part of the last couple of years. So that is a concern, especially with the GDP as low as it is right now. This sort of has the same feeling of 2007 with markets at all-time highs, and yet really, you're wondering how far forward has all the growth been priced. Now, the other catalyst or risk, depending on which way you look at this, is the next Fed meeting. The next Fed meeting is 14th of June, so we have about 2 weeks left to go before the next Fed meeting comes along. And right now, the CME is pricing about an 89% chance that Janet Yellen will hike another 0.25%. But you can really feel that the tone has really changed throughout all of these Fed meetings and the subsequent releases, where it used to be, even as recently as about a year ago, everybody was on the edge of their seats regarding every single Fed speech, every single release, every single policy. When are they going to start to raise rates? What's going to happen here? Now, everything has been fairly well communicated, and nothing is really a surprise anymore. Nothing has been a surprise when it comes to the Fed for about the last 2 to 3 years. And it's just a question of really how dovish they have been. And lately, the latest dovish thing that we got was they were going to take their time unwinding their balance sheet. Okay, which is, again, market positive. But how many more things are out there that are really market positive when we have so many things weighing on things? So right now we don't have earnings to push things along anymore. The only possible thing that could push markets forward would be some expectation that we're going to get new policy coming out of Washington. But we're quickly coming upon congressional break and holidays, things like that, where nothing is going to get done. So we're really looking at the fall. So what's going to happen this summer with markets? Now, what I really thought we had a good chance for earlier on this year was a slip into a deeper range, especially after we topped out in late February, early March. I thought that would be a great point for us to pull down in about 2,300 or so, build out a much bigger range, be able to recharge this monthly chart. We've done enough to recharge the weekly chart, but not the monthly chart. The monthly chart needs to go much more constructive action here. And that includes some type of sideways movement, pull back, anything like that. But this continual inching higher like this is going to kind of delay things, delay the market's ability to be able to actually break out from here any further until that goes through that reconstruction, because right now nobody is buying the highs. We've gotten kind of back to where we were at this point last year, where nobody was buying the highs all through this move here. After the Brexit move, after we short covered our way up here, nobody was buying the highs. The only way that the market would go higher is to get shorts to bite on the first red candle down and then squeeze them out. But no, again, nobody's buying the highs. And so the same kind of thing happened 2 weeks ago when we had our little one-day wonder to the downside. All that did was just create a spike in negativity that's been, obviously after today, pretty much expunged from the market. So here it sits waiting for a catalyst, and I'm looking at all the economic announcements. Is the jobs report really going to be that big of a catalyst to the upside? Don't know. We'll have to find out Thursday morning, beginning with ADP, and then Friday morning. So there the market sits with absolutely no reason to trade whatsoever, and this is why we saw a very, very low volume day today. Now, I got to remind you, the thing you got to watch out for here is the Russell. The Russell has been consolidated. It is ready to go. It is recharged. It's done all the work since the beginning of the year. It has been absolutely unable to go anywhere whatsoever. Every breakout attempt has been failed, and what we have to watch for now is whether or not the Russell is going to actually start to move to the downside. Now, the way that you can determine this is to basically box in this price action here from about 1350 to 1390. There's a 40-point range in here. Right now, this is a significant lower high. If this ends up being another lower low below 1390, or 1350 in this case, then that's a serious sign that all of this energy that's coiled up is coming to the downside, and it's going to expand the range on the Russell to the downside, perhaps down to the 1300 level. Again, that would be very normal, but in a case like this, the Russell might be leading. The other thing to keep in mind here is the Russell is somewhat of a canary in the coal mine as far as markets. Again, it's sort of one of those silent indicators when fund managers start to get nervous, and we're down 11 handles today, almost a full percent on the Russell, and we've lost the 50-day moving average. Again, by itself, not that big of a deal, but it's just one more piece of evidence here that if fund managers start to give up on this whole concept of risk on, and definitely Russell is a risk on asset, then that could be fund managers sneaking out the back door. That is it for tonight's report. Thanks for listening, and we'll see you tomorrow.